If you're investing in property, rental property, then this is a question that comes up quite a lot and we're going to answer it here. I'm going to flip the camera around and take you through, and it relates to holding property in a family trust. So here what we have is a family trust with a rental property that has a loss of 10,000. The issue here is that 10,000 is trapped in the trust. It can't be distributed to an individual, lowering the overall taxable income. So a way to fix this is, first and foremost, this first example is to have a family trust where you have a property that is making a loss of 10,000 as an example, but also another property that's making a gain or a profit of 10,000. So ultimately that 10,000 negative isn't just lost or just sits there doing nothing, but it's offset by the positive amount, and ultimately there's a nil balance. The issue with this particular structure is that you don't have individual asset protection for each of these properties. They're both held under the same trust. If we jump onto this example here, then you can see we have two family trusts. So we've got asset protection for this entity, but asset protection also for this entity. And they're split. They're not in the same family trust. So if a creditor was to attack this one, they can't also attack this one. They'd have to attack it separately. And there'd be reasons as to why they would go after this one. So here we have the loss of 10,000 from this property, but this other family trust here has a profit of 10,000. So what we do is we distribute from the family trust that's making a profit to the family trust that's making a loss. We need to make relevant elections here. We'll keep it fairly straightforward and just focus on the figures. So that 10,000 profit again is going to be distributed to this loss, and ultimately it's going to be nil again. But we've also got the asset protection. The third way we can do this is to ultimately have a trading company held by a family trust, and that family trust can distribute to individuals, but it could also distribute to other family trusts. So for example, the trading trust might issue a dividend to the family trust, and that family trust can also provide some of those dividends to the other asset holding family trust. So you've got 10,000 there, and you've got the 10,000 negative there. So the negative with a positive again gives you a nil balance. If this was say 15,000, then ultimately you'd have 5,000 left over, and that 5,000 could be distributed to individuals or other entities, be they artificial or natural entities in the family group. What this ultimately means is you're not going to be taxed on something that you can offset, that you can reduce, right? So this is a very, very good strategy. This helps you to continue to build your wealth, reduce your tax, but at the same time, you are effectively working ahead, looking ahead for the sleeping giant, which is the capital gain on the sale of the property. A lot of people, what they do is they think, I'll hold the property in my name. It's negatively geared. It's helping me personally to reduce my taxable income. Unfortunately, because they are high income earners, when they come to sell the property, the capital gain is going to push them higher and higher, the marginal tax rate, which means they're going to be stung with a very, very nasty tax bill. If you have it in a family trust, you can distribute to other family members and leverage their lower marginal tax rates. So overall, the family group pays less tax, which means there's more funds for the family to use as a collective.